Good evening, everyone. I'm Dan Springer, JNF CEO, and welcome to the fourth in the series of JNF Connect webinars. I hope you and your families are all well. We have a tremendous panel who will talk about managing your investments through the pandemic, and they will shortly be introduced by our moderator, Russel Pillemer. Russel is a past panelist of JNF Business Forum events, and it's great to welcome him back. He co-founded Pengana Capital in 2003 and has been its CEO since then. Previous roles include investment banker at Goldman Sachs in New York, head of its Australian Financial Institutions Group, chairman of Centric Wealth Group, and principal of Turnbull Pillemer Capital. Russell and his wife Carol founded the Aura Fund in December 2016, which distributes all its fees to Jewish charities and over the last couple of years has donated over $750,000, an investment in the future of our community and our people. This is a concept quite familiar to JNF, having been created in 1901 as the first investment fund of the Jewish people in order to create a future Jewish homeland and ensure its ongoing sustainability. Given the scale of that ambition, we were forced to take the long view, and that has been ingrained in our DNA ever since. Throughout war, peace and pandemics, JNF raised the funds necessary to buy land, create communities, reclaim swamps, plant trees, build reservoirs, lay infrastructure, develop parks, and enable a vibrant Jewish state. An ongoing effort that continues today with a focus on developing Israel's periphery, particularly in the Negev. Recent fruits from that effort include desert agriculture in Israel's south that has managed to feed a country locked down behind closed borders and help it get through this global crisis. Agriculture that was enabled by JNF-funded R&D, recycled water and infrastructure. Thank you all for your many years of partnership in helping achieve these results and your ongoing support of our shared mission. I hope you enjoyed tonight's session and now invite Russell to introduce our panel. Thank you.
Good evening, everyone. Great to be here and wonderful to see so many people joining the webinar tonight. JNF, congratulations, you're doing a great job. We actually have in excess of 200 people registered to join tonight. We are indeed living in strange times with COVID-19 rocking the very foundations upon which we have previously lived our lives. The virus has caused massive volatility in financial markets, and it's created huge uncertainty in valuations across asset classes and across geographies. Market moves have been nothing short of bizarre. Consider this. By the 23rd of March, the NASDAQ index had fallen by 30%. However, since then, it has risen by 40%, which mathematically gets it back close to where it was at its all-time high. Now, this is a crazy statistic, because consider how much worse shape the world is in today versus BC or before COVID. Against this backdrop, we are lucky to have on the call tonight 4 experts who have expertise in different sectors across the market, and I think are extremely well positioned to provide us with very relevant insights. The session tonight will be divided into 3 parts. Our panelists will provide insights into COVID-19's impact on each of their market segments. Secondly, they will give us their thoughts on how to position our portfolios and investments going forward, including hopefully providing us with their best investment opportunity ideas that are available in the market. And finally, we'll have a Q&A session. There is a chat box on the right-hand side of your screen. Please feel free to send in your questions and hopefully we'll be able to answer all the questions at the end of the night. So let's get this started. We'll start out west. Our first panelist is David Schwartz from Perth. David is the Managing Director of Primewest, a company he founded 26 years ago with 2 other partners. Today, Primewest is a $4.5 billion real estate company with a property investment portfolio that includes $1.5 billion in commercial offices, $1 billion in large retail formats, $1.2 billion in neighborhood shopping centers, and $700 million in industrial warehouses. So David, over to you. Keen to hear your insights as to how COVID-19 has impacted the property sector.
Thanks, Russell, and good evening to everybody. the start of COVID, I think, was put a lot of fear into everybody, both the tenants and landlords. From a landlord perspective, we never knew what was coming. From a tenant perspective, they thought that the world was coming to an end. They wouldn't be able to pay rent. Customers weren't going to come in, and it was really looking very, very bleak. However, as we've gone through these different phases, things have worked out not to be as bad as what everybody expected. Companies like, for example, Bunnings, JB Hi-Fi and Officeworks, in fact, did tremendously well during this period. But then there were others that did suffer, and people in hotels, restaurants, bars really have taken a big hit. The government came out with a code of conduct, which has helped us steer our way through and how to help a lot of these tenants. From a Primewest point of view, we took a slightly different approach, and we gave help, not only financial help, but financial guidance to a lot of our tenants to help them through this COVID process of being able to claim from the government. The government assistance has been fantastic for a lot of the tenants and enabled them to probably survive. And I think that the crash or the downturn would have been a lot worse. Russell, as you were saying, the stock markets have picked up to, in some cases, nearly what they were before the start of COVID. But I think that with the large amount of unemployment that's still around, that's to be questioned as to how fast and how far the markets have gone. Having said that, there are a lot of the areas that affect our sector, like, for example, the large format sector. And I think that the government stimulus from the building packages that they're putting out will be tremendous for that sector. However, when you look at some of the others, I don't think it's going to be as rosy. When you look at hotels, they're going to have a lot of problems going forward. And the biggest question mark is going to be around the retail sector. The retail REITs have been marked down heavily. I think there's still a small opportunity there. But I think going forward, we've just got to be careful in that sector as to what's going to happen. People have been buying on the internet, buying more than what they've ever bought before. And when we look at where Australia is vis-a-vis internet purchases, we're still way behind America. And when you look at what's happened in America as to how many of these companies have gone bust during this process, I think that's a sector that we've just got to be very cautious of and careful of going forward.
Great, David. Thanks. Thanks for that. We're going to move over to Melbourne now to Gary Pierre. Gary co-founded Gary Pierre and Associates with his business partner Philip Kingston in 1986. Today, the business employs 120 people over 7 office locations across Melbourne's southeast and Bayside suburbs. It manages over 4,000 residential properties across a wide area of Melbourne, as well as selling properties ranging from studio apartments to luxury homes and blocks of apartments. Gary will talk about the residential property market, something that's close to the hearts of all Australians. Gary, over to you.
Thank you, Russell, and good evening. And I think possibly in the residential sector, it's been very similar to how David's described it in terms of when this COVID started, there was a lot of fear. I think there was certainly a lot of deer in the headlights type behaviour. People just had no idea what was going on. And I think there's probably a lot of experience, probably watching on and certainly in the panel. And we thought we'd seen it all, but this was something that we've certainly never seen. So as we sort of start to find a new normal, and of course in our industry it's been tricky because auctions and open for inspections weren't able to happen as well, which we've put a lot of extra pressure on the residential sector. But certainly we seem to have found somewhat of a new normal. People are transacting again. Funnily enough and interestingly enough, prices haven't really been that affected. And I know that that's kind of a surprise. The market peaked in 2017, then kind of slowed down a bit amidst I guess the pending change of government and also the banks. If we just look back a little bit historically, I should say the changing banks, I should say the banks and the inquiry into lending. So that probably affected us pretty badly. Then things really took off late last year. The start of this year looked like it was going to be one of the best years in real estate we have had for many years. And of course, then COVID comes along and sort of pricks the balloon. But we're finding in our particular industry, the biggest problem is the volume, which has really plummeted. That's made it very hard for people in our sector. In terms of buyers and sellers, we're not getting a lot of sellers that are needing to sell. We're not sure what's going to happen, of course, when the JobKeeper is lifted. That's going to be very telling, but certainly it has affected our volume in terms of people retracting, both buyers and sellers, although the prices haven't been that greatly affected. So things are still selling, particularly the last week or two, as auctions are allowed to continue. We're finding people are coming back into the market, competing at auction and not fearful to do so. And quite frankly, if you've got a job, you're in pretty good shape. If you're secure, you've got a job, you've got low interest rates, and property and you can still get money out there from the bank. So, residential property is a pretty good alternative if you're in a position where you're able to purchase right now.
Thanks, Gary. We're going to move over to Sydney now, over to Bruce Kluk. Bruce is an owner, advisor and mentor at Principal Edge Financial Services, a company he founded in 1998 that's really centered around providing exceptional client service and understanding clients' needs. Bruce focuses on empowering corporate executives, business professionals and SME owners to create the financial comfort they seek by making sound financial decisions for themselves and their families. Bruce is an expert in constructing portfolios and in providing that overall investment experience to clients. So, Bruce, if we can hand over to you now and give us your thoughts about what's been happening across these markets.
We've just experienced what's called a black swan event, and that creates chaos, panic, fear, and uncertainty. In the face of uncertainty is one thing that we're able to control, and that's choice. Every crisis is different. The thing that hasn't changed is how you're going to actually respond to it. It's a choice on how you respond to stress. Life's uncertain, and we need to find a way to deal with this and have goals for the future. The key here is goals. Dealing with uncertainty gives you hope for a better outcome. Hope is based on a strategic rooted in academics. You've got to understand there's a difference between a wish and a hope. The hope is having your goals met. The key behind any strategy is having a plan and how to act for the long term and focus on what you control. One of the things that you've got to learn to control is how you manage your cash flow. In a matter of the last 2 months, a miraculous number of people became experts in virology in order to predict something they knew nothing about. That's the state of the market today. It also happens to be the state of the market every day, minus the new armchair virologists. Investors want to know what happens next. We take comfort in thinking we know, especially in extreme uncertain times like these. The problem lies in predicting a multitude of factors, the effects on businesses, on markets, on people's behavior, and any randomness that might incur in the process, all the while staying unbiased. In short, we're not great at predicting the future. We're exceptionally bad at predicting major turning points that have a huge impact on markets. Investing is about the future, so we can't exactly get away from it. As investors, our decision always involves some level of uncertainty. The risk is that we make a decision that turns out to be wrong, but we weren't prepared for it. That's why risk management is so important. It protects ourselves from ourselves and the consequences of being wrong. What people should be doing with their money when the economy is slowing in a recession, which typically cause riskier assets like shares and property to decline, is where we're going to need to be focused in terms of planning. Fear causes many people to run for the hills. But the short answer for most investors is the exact opposite. Stick to your long-term plan and ignore the day-to-day market fluctuations, however frightening they may be. Unfortunately, most people are not good investors. And one of the reasons for this is that the pain of losses is about twice as strong as the pleasure of gains, which leads people to act in a very counterproductive way. So when faced with a threatening situation, our instinctive response is to run or fight. But like trying to outrun a bear, exiting the market after suffering a loss is not a good idea. It often results in selling at low prices and later buying higher once the market stresses eases. The good news is you don't need a PhD in finance to achieve your investment goals. All you need to do is follow some guidelines backed by evidence and hard-earned market wisdom. First of all, don't make any rash moves because of the growing chatter about recession or wild gyrations on Wall Street. If you have a solid investment plan in place, stick to it and ignore the noise. And remember, it's all noise. Focus on your goals and have a strategy. We call the strategy a roadmap. A well-designed investment plan should focus on long-term goals and needs and not worry too much about monthly variations. Volatility is the cost of participating in the long-term benefits of equity and property investment. I've put up a checklist here of some items which can help you when you've got the storm on the horizon. Firstly, define clear, measurable, and achievable investment goals. For example, your goal might be to retire in 20 years at your current standard of living for the rest of your life. Without clear goals, people often approach the path of getting their meal and end up with a motley collection of investments that don't serve their actual needs. Assess how much risk you can take on. This depends on your investment horizon, your job security, and attitude towards risk. Diversify your portfolio. In general, riskier assets like equities and property compensate for the risk by offering high expected returns. At the same time, safer assets such as bonds tend to go up when things are bad, but offer much lower gains. To eliminate these uncompensated risks, diversify your portfolio to include a wide range of asset classes such as international equities, property and bonds, and you'll be in a better position to enjoy a downturn. Build a core portfolio with the aim of capturing the capital market return at its lowest cost. The aim in each asset class is to diversify your portfolio so that by selecting investments that add value in their own specialist way, and they have to be lowly correlated to the core. Look for low fees. Got to keep your costs down low so that you're not chewing up the return. Continue to make regular contributions to your investments, even during a recession. Try to set aside as much as you can afford, and at least annually rebalance. Rebalance the portfolio to match your long-term asset allocation targets. Doing so can make a big difference in your performance. Always keep in mind your overall investment plan and focus on these long-term goals. Many market declines that were scary in real time look like small blips on a long-term chart. In the words of a legendary investor, Benjamin Graham, the investor's chief problem and even his worst enemy is likely to be himself. Graham is the man who mentored Warren Buffett. He meant that instead of making rational decisions, many investors let their emotions run wild. They buy and sell with their gut rather than their head. So trying to outsmart the market is akin to gambling, and it doesn't work any better than playing a lottery. By adopting a disciplined approach and never confusing long-term investment with speculation, you enhance the probability of a better investment experience.
Bruce, I'm gonna cut you off there, just because it's great.
One last thing to say. Fasten your seatbelt. You'll be able to ride out the current turbulence.
Fantastic. Thanks, Bruce. We're going to move over to Jessica Roth. Jessica has substantial experience in the impact investment and ESG investment segments. She is the founder and director of Social Impact Hub, which collaborates with purpose-driven organizations to advise, educate, and mobilize capital to accelerate change. Based in Sydney, the hub supports social enterprises, corporates, not-for-profits, impact investors, and funders to design, support, demonstrate, and scale social impact. She's also a consultant to the impact investment sector. Now, this impact investment sector is a really incredible sector. It's growing in leaps and bounds. Jess, I'm going to pass over to you maybe just before you start talking about what's happened in your sector. You can just give a really brief overview of what impact investing and ESG investing is all about. You're on mute, Jess. We still can't hear you, Jess. If everybody else can go on mute. You know, Jess, we still cannot hear you. I don't know if anybody else can hear Jess. I think we're having a technical difficulty. Jess, I might get you to log on out and to log back in again, because we can't hear you. Okay, great. We'll carry on, and Jess will join us soon. Maybe David, if I can pass back to you and just ask your thoughts on, give us some ideas of what can we go out tomorrow morning and look at buying? Where are the best investment opportunities, or what should we be selling in our portfolios when it comes to property?
When you look across the board, there are opportunities, and I think that unfortunately, if this call was a week ago, there would have been a lot more opportunities. As you know, and as you said, the market has run, and a lot of those really, really good opportunities have now been, the share prices have moved up. But when you look across the board and you look at some of the share prices, there are most certainly still opportunities. Companies like, for example, GPT or Abacus, they're still between 20 and 30% below their net asset value. And there's no reason to think that their net asset value would have dropped by that much. If you look at their portfolios, and yes, it is a mix of portfolio, and people like GPT do perhaps have a bit of retail in there, but the 30% that they are down below the net asset value is probably still too much. And if you look across some of those REITs are still presenting good opportunities. Another one that I like, which I think is still good value, and it hasn't really shot up as much as everybody else, is, for example, Australian Unity. That's still trading at probably 25% below net asset value. There's still good returns to be had across the sector. There's people like Vicinity and Centre Group are still heavily discounted, but I think that those discounts reflect the reality in the market. The retail sector is still going to come under a lot of pressure. And in property terms, and especially like with offices or in the retail, things don't happen fast. It's a slow turn of events. And I think that in the retail, we all know it. And we all know that as online is getting stronger and stronger, that whole sector is going to have to readdress where they're at and what they do, and whether it becomes more entertainment. Some of the places, like, for example, where Target are closing up, could become last mile warehouses and facilities. It's an interesting thing to have a look what's happening in the US with JCPenney in Chapter 10. Amazon are looking at them to perhaps use some of their stores as last mile distribution centers. So all of that is changing. Hotels, I think, are going to be down for a while. I don't think we're going to see international travelers coming through for a while. But industrial sector is still extremely strong. We most certainly found that, albeit in the COVID and the downturn, our collections were probably as high as 95% across our portfolio. And just generally with the strength of the internet, and I think that there's going to be a rebound in some of the manufacturing, and also the manufacturing from the housing point of view is going to be pretty strong. I think that in the industrial sector is the sector that you really want to be in. I also still like the neighborhood center, what we call daily needs. Our view is always that people still enjoy the social event of going out shopping, going to get your groceries, and things like haircuts, nail bars. You're never going to have them over the internet. So from that point of view, you do have a level of protection, and they will still give good returns. A sector that's very often been overlooked, and that's agriculture. It's a sector that we're going into. It's a sector that I think is worth looking at, and there again gives solid, stable returns. And our farming properties are probably 20% cheaper than what they are in other places in the world that would produce exactly the same end result. So agri is one that's really worth looking at.
That's really interesting.
That's great. That's great. Thanks, David. I think we're all putting in our orders tomorrow morning. Back to you, Jess. If so, you're back in the room. Hopefully, we can hear you this time.
Can you hear me now?
Yeah. Well, why don't you talk both about handle the question as one, both about what's happening in the sector and where you see interesting investment opportunities arising from COVID.
Sure, Russell. Thank you, and thank you, JNF, for organising this panel. I might go back to your original question, Russell, first, which was just to define impact investing, just to make sure that everybody listening tonight is on the same page. So there are three key parts of the definition of impact investing. Firstly, the intention to have a positive social impact or environmental impact, as well as a financial return. Secondly, measuring that impact. And that's really important, the measurement of impact. And the third aspect is that ideally an impact investment would provide some element of additionality. So something extra over and above what would have happened without the investment. Now, what's the same between impact investing and regular investment is return. And that's a really important point to note. Impact investment, even ESG investment, which I'll come to in a moment, there's no expectation that you necessarily take a haircut on the return. There are market exceeding financial returns, risk-adjusted financial returns available. The other really important point to note in the impact investment sector, if you like, the way we've put the question, is that it's not really an asset class in and of itself. I see impact investment as a lens through which you view all investments. So you can have a fully diversified portfolio, as Bruce said, across asset classes, as you should, that has a lens of impact over it, where you're looking for a positive social and environmental impact as well as the financial return. So you can have direct property, indirect property, listed equities, bonds, everything fully diversified, but all with an impact lens. So the market was started, if you like, by some early movers, which were mostly charitable trusts and foundations set up for the purposes of doing good. And so it doesn't make sense to have your investments causing some of the problems that you're trying to solve with your grants, on the other hand. So certainly charitable trusts and foundations have been market leaders in adopting impact investment strategies. But over the years, in raising impact investment, there's been many people investing through their self-managed super funds because the investments are good and people feel good about them because at least there's an alignment with your values as well, and you know you're doing some good in the world. And we're now seeing institutional investors adopting impact investment strategies with super funds committing, including Hester, making a reasonable commitment, and QBE as well has a $100 million allocation to social impact bonds. And that's a really interesting point. The reason why, one of the many reasons why QBE has made such a big investment or commitment to impact investment and they're deploying it, is the fact that social impact bonds specifically are uncorrelated to other asset classes. And so that's a really interesting point as we're talking about shocks to the market given COVID-19, that if you can be diversified into areas that are uncorrelated, and in an economic downturn, there's often a greater need for social services. So there'll be more people homeless, especially when JobKeeper ends. There's more need for intensive support. There'll be more need to support people to transition to employment and retraining and skills. So some of the social needs and the bonds that have been structured that benefit, they could almost benefit in an economic downturn. So it's a diversification as well. So that, I suppose, gives you a little bit, from a big picture perspective. The Responsible Investment Association of Australia has actually just released some data this week about the state of the impact investment market. And it shows that in the last 2 years, the market has experienced an exponential growth, and it's got to $20 billion. And the current impact investors want to basically 5-fold increase their commitment to impact investment over what they're currently allocated. So the market is set to tip $100 billion very shortly. And so I think that's encouraging news for the impact investment sector. And the broader government and societal move to build back better in the economic recovery I think will also open up opportunities for other environmental impact investments. Certainly clean energy is a big impact area. And on the social side, big areas of opportunity, to your question, Russell, in relation to affordable housing, big area of potential growth. Ed tech, I think it's been quite amazing how the transition to online learning happened so quickly, with kids going home and learning from home. And that's sort of encouraged the adoption of online learning and online education much more quickly. So I think those businesses that are utilizing tech to deliver education or even to deliver health, telehealth wasn't a big thing 6 months ago, and it now is. So those tech trends, I think, will be accelerated, and there will be opportunities for direct equity investments into those sorts of companies as well, that are riding those technological changes that were happening anyway, but have been accelerated as a result of COVID-19.
Thanks, Jess. That's great insights. I've certainly seen that in the marketplace, where the amount of investors wanting to invest to do good has really driven up the demand for those assets, and therefore the pricing, etc. And I think more of that is certainly to come. Gary, over to you. Where should we be buying our next apartment or house?
Yeah, I wish I could tell you exactly the address, but I guess I think personally I have a lot of confidence in land. I think we're going to see a few interesting things happening in land, because we've found recently, the last few years, it's been very difficult, for example, to get permits to build. And I'm just thinking that at the end of all of this, I think there's going to be an appetite from governments to see more building. I think we're going to see a much greater appetite for building and development. And I think some of the fierce opposition to that is possibly going to not be as fierce as we've seen traditionally. So I'm a big believer in land. Clearly, we want to be in good locations, and good locations, of course, they don't really change. We're talking about locations that are close to amenities and close to transports, good schools particularly. I think also in the years ahead, we can presume we'll see some more immigration, and that's going to drive the price of land up as well. So land will probably be the first thing I would be saying we should be looking at and seriously getting involved in good locations. And I know that sounds very kind of traditional, but it is a very safe bet, and I think we are going to see some upside. The market has been really starved of stock, and this is right across all of the best areas of Australia. And I spent a bit of time speaking to agents from other states, from Sydney and Perth and Adelaide, and everybody has found that the volume has dropped. So this might bring some people out to the market. I don't know if I'd be expecting a lot of forced sales. I think there'll be more people selling their homes because they're dissatisfied with being stuck at home with their partners than because they need to financially do so. And we're finding, that's a horrible concept, but it actually is a reality. We're getting people ringing up saying, I've had about enough of her or him. And that might bring a bit more on the market at the end of this whole COVID thing as well, which you wouldn't have necessarily thought. The other thing just to be careful of is land tax. I think, certainly accumulating a lot of land in any particular state can really sting you with land tax, and it takes all the return out of it as well. The returns on, good blocks of land haven't been great. They have been pretty low, sort of 3 or 4%. But right now, with the interest rates that we're seeing right now out there in the banks, and some of the returns and some of the fear around the stock market being a little bit shaky or maybe changing, I think some of those returns are going to look good as well. So I'll probably be pretty confident about buying land, good apartments, established apartments in great suburbs. They're also very popular, and I think they're a very safe bet as well. But those kind of risky suburbs that can change and get better, that I know a lot of people have got an appetite for. Sometimes you can hit the nail on the head and get those right. Other times they are exactly that. They are risky suburbs, and if they don't go ahead as you would hope them to be, you might have lost an opportunity to buy something a bit more blue chip.
Awesome, thanks, Gary. If I just can remind everyone that to use the question board to send through your questions. Bruce, over to you. Some words of wisdom about what to be buying and selling.
in market declines like we've had now, it makes people nervous, and you're not alone. So what I've done is I've listed 3 facts to consider about market recoveries. And the first one is recoveries have been much longer and stronger than downturns. In past periods, when we go back in history, the downturns are normally very sharp, but the market recoveries tend to last a lot longer and can be up to 5 times longer in time. The second fact, that after a large decline, recoveries tend to be quick, and we've seen that happen now. And you've heard them talk about a V-shaped recovery or a W. It's been a very sharp V to date. The key thing is we need to understand is earnings. The earnings need to have to start to come through to support the valuations that we're seeing of the current prices. The third fact is some of the world's most influential companies were born during market recoveries. To highlight just a few. In 1948, McDonald's emerged during the downturn caused by the demobilization after the wartime economy. Walmart came along 14 years later, and that was during the flash crash of 1962. Airbus, Microsoft, Starbucks were created during the stagflation period in the 1970s. And not long after that, a man by the name of Steve Jobs walked into his garage and created a company called Apple. History has shown that strong businesses find a way to survive and even thrive when times are tough. Those can adapt to difficult conditions and become stronger, often make attractive long-term investments. The key is how do you actually manage the portfolio and try not to be an active stock picker and chopping and changing all the time, because that's when you tend to lose. 3 mistakes investors should avoid is trying to time the markets. It's time, not timing, that matters in investing. Mistake number 2, assuming today's negative headlines make it a bad time to invest. Great investment opportunities often emerge when investors are feeling more pessimistic. Mistake number 3 is focusing too much on the short term. Market volatility is especially uncomfortable when you focus on short-term ups and downs. Extend your time horizon and focus on the long-term growth of your investments and the progress you've made towards your goals.
Awesome, Bruce. Thanks.
We can't hear Russell now.
Oh, sorry, I wasn't. Thanks, Bruce. That's great. So just before we move on to Q&A, I just thought I'll give you some of my key recommendations, ideas for where to look for good investments. So the first recommendation is to take a look at global small cap investing. Global small caps are we call them small caps. They are small companies. Companies may be only worth a few $100 million of market capitalization. Now, I mentioned how the NASDAQ has sprung back into action. It's mostly due to the very large technology stocks that have really, their share prices have recovered and even higher than they were before. You might have heard of the Fang Stocks, which is Facebook, Apple, Amazon, Netflix, Google. Now, it's those stocks that have really just risen beyond belief. If you had thought that there was an opportunity a few months ago to buy them at very cheap prices, well, that opportunity has disappeared today. It doesn't exist anymore. But the good news is that that hasn't happened with all stocks. These smaller stocks around the world are actually still, there are a lot of them that are still at really great value. So if you can find a fund manager who knows how to find these types of stocks, take a look at that. That's a really interesting space. And my second tip is going to be something that's really going to be music to the ears of everyone on this call. One of my best tips for where to invest at the moment is actually in the Israeli listed company space. So Israeli companies were really attractive before COVID, and it is mostly because of great technological innovations as well as recent changes that have taken place regarding the Tel Aviv Stock Exchange. And now this market has become substantially more attractive after COVID because investors around the world, I think, have increased the value that they place on technology and biotechnology. and also have developed an increased appreciation for Israeli ingenuity, which has really been highlighted over the past few months. So it's nice to be able to get some positives out of something so terrible as COVID-19. But I think the prospects for the Israeli market are fantastic going forward. So that ends the formal part, and now we'll switch over to questions. So I might start, David, with a question from you, and that is that if people are so comfortable with working from home now, what's going to happen to office properties?
Yes, it's a question that's been asked a lot, in that some people have quite enjoyed working at home, and I think that the enjoyment lasted for about 2 weeks, and a lot of people after that got either bored or got distracted, and most certainly some of our staff were quite happy to come back. But I do think that it is a factor that is going to affect rents. It's going to affect the way we work going forward. If you look at some of the stocks that are predominantly in the office market, they've been marked down in the anticipation that people are going to look to try and work from home more. But I think that this is going to take time. You must remember that a lot of these people have got leases in place, and also COVID, with the social distancing that people are going to want and require at work, is going to require more space anyway. So the one is going to balance the other one out. Yes, there are going to be people that want to work from home, but it's not always going to be possible or practical. What's going to be more interesting is to see how the landlords react. And my advice, and what we're looking at doing, is making the office slightly more exciting and interesting. The fit out has got to be more interesting, gymnasiums, facilities, to encourage people to prefer to work from an office than working from home. Remember also that human beings like to socialize. People like that social aspect and like to have the routine of going to work, going to an office, meeting with people, rather than interacting with Zoom meetings the whole time.
Thanks, David. That's great. Gary, next question for you. There's a lot of doom and gloom in the press at the moment, and I see a Commonwealth Bank. We have a question here, so I'm just looking for it. A question from Ben, who says that CBA are tipping property prices to fall by 10%. Should we wait until they fall by 10% before we buy? Or are they not going to fall by 10%? What's the view there?
Yeah, well, it'd be great if we knew the answer to that. Personally, I have got a lot of confidence in the market being upheld just by the fact that I think good property, particularly residential properties, will continue to be sought after. I don't see it necessarily dropping, or certainly not that quickly, but it's possible that will happen. Again, we're going to find maybe a very different place when JobKeeper goes, because that's when really, I guess, the life support gets turned off from the government. Now, having said that, we've also got a time where people are back to business and back to work, and if more businesses survive than we think, then it may well be that things aren't as bad as we think. One thing we're very aware of is there is a lot of people out there who want to buy property. There's a lot of pent-up demand. There's a lot of people that are poised, that are waiting and have waited, and we've had a real problem with volume, and maybe that's what's holding the market up. There could be a contrary argument for that, but it feels and seems to us like the market isn't going to be going south in a big way, in a big rush. And I think we might have sort of felt that by now. We haven't. That doesn't mean it won't happen, but personally, I wouldn't be fearful about jumping in now rather than waiting till later. I'm not sure you're going to see a flood of stuff coming on, and I'm not sure you're going to see a lot of discounted good quality property either.
Right, thanks, Gary. Next question for Bruce. So, Bruce, yields are extremely low at the moment. You spoke about a diversified portfolio. Considering how low those bond yields are, should I still have bonds in my portfolio? Does it make any sense?
Okay, so with bonds and fixed interest securities, they're going to have a lower yield unless you go more into the credit side and go longer dated. Interest rates have remained low for some period of time, but you've got to understand the perspective and role of why you have what we call defensive assets in the portfolio. They're there to act as a shock absorber. They're there to act as the liquidity provision so that you don't have to sell the property holdings. You don't have to come out of the commercial, industrial, residential properties or equities at the wrong time. They will provide you some yield, but yields across the board today, across dividends and rents, have all come down substantially. And they're all going to be and expect to get yields on average, on a rolling 5-year average, running at about 3.5%. There might be some tax credits that go with it, but the bonds are there to actually protect the portfolio and provide you with liquidity. But remember to always do it on short dated. Don't go too long at this period of time. Try and keep your fixed interest and bond portfolios below 5-year maturing periods so that you've got and spread it across various kinds of securities within that.
Great, thanks, Bruce. Jess, next question for you. The energy sector has been very hard hit by over COVID-19. In the green energy sector, do you think there's opportunity at the moment, and what sort of things should we be looking at?
Yeah, it's a good question. I think there definitely is opportunity in the green energy sector. We need to transition to a low carbon economy. So there will definitely be opportunities in renewable energy, in solar, in wind. Definitely for the moment, there's been certainly a drop, but I'm confident that it will recover. I think it's interesting just to note and to connect it to your previous question, Russ, the ethical portfolios on average have dropped less than a non-ethical portfolio, and they have been less volatile. And that's partly because they haven't held oil, which has dropped significantly. And they also are more exposed potentially to growth sectors, like I mentioned before, like health and education, and potentially overweight in more defensive assets as well, to Bruce's point. So that's a really interesting point. And to your point, Russ, about some tips that people should be looking. Yes, I think people should be looking at green energy, but more broadly, look at implementing an ethical portfolio. It has outperformed over the past period of time. It's been less volatile, and that bodes well for it outperforming in the future. And the growth sectors that are held in ethical portfolios are the sectors that underpin economic growth. We all need food, we'll all need energy, we need housing, and so that underpins economic growth in that supports an ethical portfolio. Aside from aligning with your own values and excluding things that you don't necessarily believe in or you want to invest in. And that's, I think, another important distinction with ESG investing. Those of you that don't know, ESG is environmental, social, and governance investing. And many of those ethical portfolios are just negative screening. They're taking out things that they see as bad, the managers see as bad. And impact investing is actually looking for positive social impact or environmental impact, which is even better.
Great. Fantastic, Jess. Next question got here from Ariella. How does one enter the Israeli market? There are funds available in Australia that invest specifically in the Israeli market, so you will be able to find those. And that's if you want to invest in the listed market space. If you want to invest in, most of the investing that people talk about when talk about investing in Israel is in the unlisted or venture capital space. That's a little bit more challenging. It's harder to come by those things. You sometimes need to know people, need to go into private offerings. There is a lot around, but you can both, enter Israel both, as I said, in the private space as well as in the public space. And I don't think there's any shortage of opportunity.
Can I add something to that, Russ?
Yes.
I think that for somebody in Australia that wants to invest in Israel, to go through a managed fund that's available here that can be holding Israeli securities that are listed either in Israel or on the NASDAQ is a very effective way to manage it. It manages the currency and it manages the exposure. They're on the ground there, and you've got liquidity through it as well. But again, it's not a short-term investment.
There's also a platform called Our Crowd that basically allows people to choose their own private equity venture style investments, and they have a lot of Israeli companies on the platform. It's run out of Israel.
Yeah, and some fantastic stuff. I think it's for I'd say for a much more sophisticated investor who's comfortable that they understand technologies, understand they're happy to make their own investment decisions. Gary, switching back to you, what's happening with rentals? What do you see the pressures and the developments there?
Well, most of the properties we manage, in fact, we don't manage commercial properties, but I feel for the commercial agents right now. And of course, the landlords, things are very difficult in that space. And, when COVID first happened and that sort of immediate time, I think, most commercial agents were probably collecting, I would say, well, the reported figure was somewhere between 40 and 50% less rent. So that happened very quickly. In the residential space, I think if there are residential investors there, the best advice I can give you right now is move to meet the market, because we've got a few landlords that are hanging in there holding out for rents that just aren't there at the moment. So I certainly think that, if I look at the last batch of rents, I think the last 100 properties we've leased out, 2/3 of them were leased out for less than they were before. 27% were the same and 7% were more. So very few rents are up right now or what they were. We are certainly seeing the residential space a lot less rents. Rents have dropped in some cases 10, even 15%. That's for new fixed term leases. Many other landlords are giving people 30% discounts, 25% discounts just to be able to bridge the gap for the next 3 to 6 months, probably 3 months more so reviewable. But I would be certainly encouraging landlords to be doing those deals, because you don't want occupancy right now. It hit Sydney very quickly. And I know that, as soon as things changed, Sydney, you couldn't get a tenant. And now it's come to Melbourne, and I dare say it's in other states as well.
Okay, great. Fantastic. David, one for you. For those of us who come from Sydney or Melbourne, can you give us some insights as to the Perth market, or maybe the Brisbane market, or some other cities? Should we be looking to extend our property portfolios into those markets?
So Perth, for example, I would call it a counter-cyclical market at the moment. Perth has not had the gains that Sydney and Melbourne have had. And if we look at some of those buildings, and the office buildings, especially in Sydney, Melbourne, those could come off a bit, whereas the Perth office market hasn't risen to the same extent, so it won't fall. We're still seeing, and we're encouraged by a lot of new take up of space. There is still in Perth, and especially in the office market, there's about a 17% vacancy, but that seems to be dropping on a month-by-month basis. The Brisbane market is pretty much the same. It ran a little bit harder than what the Perth market did, but there's still buying opportunities in both these markets. In the rest of Perth and both Brisbane, neighbourhood centres or industrial, there's still plenty of opportunities to be able to invest, and that market hasn't really been affected, as I said before, both Sydney and Melbourne, Perth and Brisbane. They're still pretty strong and pretty good opportunities there, remembering that interest rates are exceptionally low at the moment, and you can get some very good returns on both industrial office markets and even the large format. The large format market, like I said before, was hardest hit, but with the government stimulus coming through, I think that market will be pretty solid and pretty steady, and could even be buying opportunities there too.
Thanks, David. I think we just have time for one more question, and the question I think, which is a relevant one, is why have markets risen so sharply over the last 2 months? And I'll probably answer that one myself. Really, what's happened here is that the market has been flooded with cash by governments around the world. So governments have pumped a massive amount of liquidity into the markets and have made money really, really cheap. When money is really cheap, investors take that money and they use it to buy assets. Now, the big question is, how much longer can governments do that? And the second big question is, what are the long-term impacts of that? Usually you will see inflation coming out of that, but this has got a long way to play out. So watch the space. It will be interesting. I think the key piece of advice for investors is, I think as Bruce said before, don't do anything too radical. Stay the course. Watch things closely. Things can change on a very frequent and daily basis. Keep your eye on the long term. Generally we find that markets and asset prices do go up over the long term. So if you can hold it long enough, you're sure to come out well. I'm really sorry we haven't been able to get to everybody's questions tonight. We've got dozens and dozens of questions. Apologies for that, but hopefully we got to answer some key ones for people. To the panelists, thanks so much. There was great insights. I really appreciate your contribution. And to JNF, great work. Keep up the great work, both in organising these webinars as well as in supporting projects in Israel, which is very near and dear to all of our hearts. Thanks, everybody, and good night.
Thank you. Good
Thanks
night.
very much.
Bye.
Good night.
Good night.